Hey guys, so in this video, I'm going over my top 6 stocks for the month of March 2021. I've spent the last month going through hundreds of companies, and this is my list of stocks I think are the best buys right now. Be sure to watch all the way through to get my full analysis on each of these companies. I'll go over key numbers, recent news, and why I expect them to grow and make you money. Huge shout out to Audible for sponsoring this video. So let's get started. The first stock on my list is ZYNGA, stock ticker ZNGA. This is a mobile gaming company that was founded in 2007. They are the creators of games like Farmville, Zynga Poker, and a lot more. And they are heavily reliant on the freemium model, aka free games with advertisements and in-game purchases. Right now, Zynga is trading at $11.29 with a 52-week low of $5.65 and a 52-week high of $12.32. If we take a look at their 1-year price chart, we can see that they dropped into the 5s and 6s at the start of the pandemic last year. But since then, they've risen. We saw a minor correction back in November. And since that correction, it's been up over 30%. Zynga has a market cap of $12.182 billion. We don't have a PE ratio because they're not yet profitable, an earnings per share of -42 cents, and they do not pay out a dividend. Right now, they have a price to sales ratio of 6.27 and a price to book ratio of 4.47. As far as profitability goes, like I said, they are not yet profitable, and they currently have a profit margin of -21.74%. Their return on equity is also negative at -17.47%. As far as their balance sheet, right now they are sitting on about $1.57 billion of cash, and they have a pretty good current ratio of 1.4, meaning they have 1.4 times the current assets as current liabilities. And it's always cool to see what analysts have to say. So on a scale of 1 to 5, 1 being a strong buy and 5 being a sell, analysts are rating Zynga as a 1.9, meaning it is a buy. And the average analyst price target is $13.04, which is almost 20% higher than the current price of $11.29. So Zynga is definitely a short-term hype stock that is very popular among retail investors. It's very cheap per share, but that doesn't mean that it's necessarily cheap overall. A lot of value investors will not like the numbers for Zynga, as it does appear quite expensive right now. However, I do see Zynga's business model working well for the next decade and beyond. So in 2020, Zynga's revenue was up 49% year over year, and they expect to have revenues of $2.6 billion in 2021. This is up from $1.97 billion in revenue for 2020 and $1.32 billion in revenue for 2019. Another great thing is that they have a healthy balance sheet with lots of cash. While their first games on Facebook have declined in popularity, they are great at acquiring new games in their early stages and subsequently turning them into cash cows. For example, they purchased Peak Games, the maker of Candy Crush, in 2020. The mobile gaming market is poised to grow in the coming years, and I have no doubt that Zynga can ride this wave. It's not yet profitable, but they are rapidly expanding into other platforms through its partnerships with Amazon Web Services and Unity Software. Now, you may be able to swing trade this for hopefully a gain, but also possibly a loss, as it is quite volatile. But if you don't care about the short term and you are down to hold the stock for many years, I really do think that it can give you a good return on your investment. Just be aware that if they don't continue growing as investors are expecting, the share price could definitely see a big hit. So I will definitely be adding some Zynga stock into my own personal portfolio. All right, the second stock on my list is KB Home, stock ticker KBH. This is a US home building company, and they purchase plots of land and construct new homes that they then sell to home buyers. They also have in-house insurance, title, and lending services. So right now, KB Home is trading at $41.61 with a 52-week low of $9.82 and a 52-week high of $45.59. KB Home saw a huge decline at the start of the pandemic last year, but ever since then, we've seen relatively stable growth back to where it is right now. And yeah, right now we are just about 10% under its 52-week high. KBH has a market cap of $4.109 billion, a PE ratio of 13.28, which based on any other company on this list is super low, which is a good thing, and earnings per share of $3.13, and they pay a mild dividend of 1.48%. Now, we currently don't have a 5-year expected PEG ratio, but the current price to sales ratio is 0.93 and the price to book ratio is 1.54. Both of these are quite low, which means that it could be undervalued. Now, looking at their profitability, we can see an overall profit margin of 7.08%. And they also have a pretty good return on equity of 11.73%. Now, for their balance sheet, we see that they have total cash of $681.19 million and a very, very strong current ratio of 5.95. As far as what analysts are saying, right now they are rating KBH as a 2.4, meaning it is between a buy and a hold. And the current average analyst price target is $47.42, which is about 15% higher than the current price of $41.61. So KB Homes is one of the largest home builders in the US, and I've actually represented buyers who have purchased from them. They have a very efficient sales process, and they are able to get homes purchased pretty quickly. Now, the demand for homes are at an all-time high, and this is due to a smaller market of homes being sold, people wanting to upgrade their home, and low interest rates. In fiscal year 2020, earnings were $3.13 per share for the whole year, which was an increase of 10% from the year before. Also, the earnings per share is expected to grow about 63% this year due to the strong housing market. For the upcoming quarterly earnings report, analysts are saying that they estimate KBH to have earnings of 87 cents per share, which would mean year-over-year growth of 38%. So it is interesting to note that right now, KB Home has a huge backlog of home orders, which was one of the reasons why we saw Goldman Sachs upgrade KB Home from a sell to a buy, with a new price target of $51. And yeah, that means that there should be a big influx of cash in 2021 from these backlogged orders. And with a great history of earnings increases and what I believe to be a great business that has also created profitable branches in lending, title, and insurance, this should make KBH a great buy for the month. So I want to take a second and thank this video's sponsor, Audible. I am a huge fan and user of Audible, and they're the leading provider of spoken word entertainment and audiobooks. Right now, Audible is giving members even more with the all-new Plus catalog included with membership. They have thousands of audiobooks, podcasts, and more. One of the best libraries I've ever come across. Members also get 1 credit every month, good for any title in the entire premium selection of bestsellers and new releases that you get to keep forever. For example, one of my favorite recent listens was Tax-Free Wealth, a book that shows you how to build wealth by lowering your taxes. With any Audible membership, you can download titles and listen offline, anytime, anywhere. And seriously, the knowledge and entertainment that you get with these audiobooks is amazing. The Audible app is free and it works on all smartphones and tablets, so I routinely listen on the go when I'm driving, working out, traveling, and more. Visit audible.com/charliechang or text charliechang to 500-500 to start exploring Audible with a free 30-day trial now. And now back to the video. The third stock on my list is MasterCard, stock ticker MA. This is a financial services corporation that provides transaction processing and other payment-related products and services. They currently have the second largest credit card payment network in the world. So right now, MasterCard is trading at $367.32 with a 52-week low of $199.99 and a 52-week high of $368.79. Their one-year price chart shows a huge drop at the beginning of the pandemic all the way to $200, and since then we've seen a steady increase in the price with a small correction and then a recovery back into the low to mid 300s. MasterCard has a market cap of $364.88 billion, a PE ratio of 57.66, earnings per share of $6.73, and a very mild dividend at 0.5%. They do have a 5-year expected price to earnings growth ratio of 1.76 and a rather high price to book ratio of 51.79. Now in terms of profitability, this is an area where MasterCard does shine, with their overall profit margin at 41.9%. They also have a very, very good return on equity of 102.51%. In terms of the balance sheet, right now MasterCard is sitting on $10.6 billion of cash, and they have a decent current ratio of 1.71. Right now, analysts are rating MasterCard as a 1.8, meaning it is a buy, and the current average analyst price target is $384.42, which is about 4% higher than the current price of $367.32. So MasterCard is definitely not a hype stock to invest in, but they have been around for many years, and I do believe that they are positioned to grow in the coming years. I've already talked about Square, Visa, and PayPal, and those have all been performing quite well. I still recommend buying those, but MasterCard is one that few people are talking about nowadays. I mean, like I showed, this company is a cash cow. Its profits are high, its return on equity is high, and they have a fantastic balance sheet. For example, in Q4 of 2020, MasterCard beat analyst expectations, hitting $4.1 billion in net revenue. Although I will say that this was still a decline from the past year. The main reason for the decrease was due to reduced travel spending during the pandemic. However, gross transaction volumes were actually up 1% year over year. So MasterCard did perform better than the analysts thought they would. They also expanded key partnerships, acquired Finicity, and will be growing as a fintech innovator this year. Also recently, you guys, it was announced that MasterCard would start facilitating crypto transactions in 2021 due to the growing interest in that sector. And with the pandemic seemingly slowing down now, it should be a good few years of recovery for transaction volumes across the globe. The transition from cash to credit seems like it has already happened, but in many places of the world, it's just not the case. MasterCard will be in a prime position for that shift, and that's why I think it could be a great long-term buy. Okay, number 4 on my list is Avalara, stock ticker AVLR. This is a cloud-based software company that develops software for worldwide tax compliance and preparation. Right now, they are trading at $162.97 with a 52-week low of $55.50 and a 52-week high of $185.37. Just 1 year ago, they were trading in the 50s, and since then, this company has grown significantly. Avalara has a market cap of $13.78 billion. They don't yet have a PE ratio because they're not yet profitable, with an earnings per share of negative 61 cents. Right now, their price to sales ratio is 28.42, and they have a price to book ratio of 13.75. Now, like I said, they are not yet profitable with a profit margin of negative 9.83%. They also have a negative return on equity of negative 6.37%. For their balance sheet, we can see that currently they have about $673.59 billion in total cash, and they have a pretty good current ratio of 2.2. Right now, analysts are rating Avalara as a 1.6, meaning it is between a strong buy and a buy. And the current average analyst price target is $209.23, which is about 25% higher than the current price of $162.97. So tax compliance is extremely difficult, especially for businesses. Avalara's systems automate this tax compliance, and with the pandemic, the importance of these automated systems has become more and more clear. These businesses are always looking for more ways to increase operational efficiency, and Avalara's software does help them do that. As you guys saw, shares of Avalara have risen in value greatly, and with the most recent quarter showing $144 million in revenue, we can totally see why the price of the stock has gone up so much. This means that revenue is up almost 35% year over year. They've also released their 2021 revenue guidance of 26%, which although is less than 35%, is still impressive. The company is not yet profitable, but their operating loss went from $5 million to $1 million in the past year, which is a good sign. In December, Avalara said that they would be acquiring Imposia, which is a German tax software company. Most analysts seem to think that this acquisition will be beneficial in helping the company onboard a bigger workforce, as well as adjust better to the tax regulations in Europe. As we see Avalara expanding more into international territory, I do think that this company is poised to do well in the long term. Its valuation right now is high for sure, so if this is a company that excites you, perhaps start off by buying any dips that you guys see. It may be more volatile if certain growth measures are missed, but overall, I do think that this could be a great stock to hold in the long term. Number 5 on my list is ZENDESK, stock ticker ZEN. This is a software development company that is focused on customer relationship management with flagship products like ZENDESK Chat. The products are all centered around this customer service experience and allow businesses to communicate with their customers in new ways. So right now, ZENDESK is trading at $150.16 with a 52-week low of $50.23 and a 52-week high of $166.60. We saw the lows of the stock back during the start of the pandemic, but since then we've seen almost a linear growth upward. ZENDESK has a market cap of $17.683 billion, no PE ratio, and an earnings per share of negative $1.89. Right now, their 5-year PEG ratio is 3.47, and they have a price to book ratio of 43. In terms of profitability, like I said, they are not yet profitable, and their profit margin right now is negative 21.19%. They also have a very bad return on equity of negative 49.04%. Right now, ZENDESK has about $971 million in total cash, and they have a pretty good current ratio of 1.84. As far as what analysts say, they are currently rating ZENDESK as a 1.9, meaning it is a buy. And right now, the average analyst price target is $178.24, which is 20% higher than the current price of $150.16. ZENDESK is a fast-growing company whose revenues have grown 20 to 30% each year for the last 5 years. In quarter 4 of 2020, revenues were up 23% year over year to $284 million, with a GAAP operating loss of $55 million. In 2020 as a whole, they saw a GAAP operating loss of $155.9 million. So they're not yet profitable, but with a big uptrend in revenue. Now for 2021, ZENDESK is expecting total revenues in the range of about $1.3 billion. In recent news, ZENDESK announced the general availability of ZENDESK Suite, which is a new package that includes all of their platforms in one. I'm a big believer in what their software does, as it does facilitate personalized customer relationships. If companies want to build customer loyalty, they'll need to start with using a software like this. The uptrend in messaging as a means of communication between businesses and customers is very apparent, and this coupled with the rise in e-commerce places ZENDESK in a great position. If ZENDESK can continue to onboard new companies in this growing space, I have no doubt that that they will perform very well over the next few years and more. And that is why, you guys, I will be adding ZENDESK to my own portfolio. The last stock on my list is Apple, stock ticker AAPL. This is a massive American tech company that you guys have all heard of, and they make the iPhone, the MacBook, the iPad, and tons of other products, software, and online services. I've definitely talked about Apple before, but I still think that right now it is a great opportunity to buy at the current price. So yeah, right now Apple is trading at $125.35 with a 52-week low of $53.15 and a 52-week high of $145.09. We can see that back in March, that's when they hit their low of about $55, and since then it's gone up significantly with a slight correction in September and also a slight correction in the recent month. Apple is a gigantic company and they have a market cap of $2.1 trillion. Their PE ratio right now is sitting at 34 and they have an earnings per share of $3.69. They also pay a small dividend at 0.65% based on the current valuation. Now their 5-year PEG ratio is 2.79 and they have a price to book ratio of 31.94. As far as their profitability, Apple is doing quite well with a profit margin of 21.74%. They also have a very sky-high return on equity of 82.09%. Their balance sheet shows that they are doing very well right now in terms of their fundamentals with total cash of $76.83 billion. They also have a decent current ratio of 1.16. Right now, analysts are rating Apple as a 2, meaning it is a buy, and the average analyst price target is $151.75, which is about 20% higher than the current price of $125.35. Now, like I said before, we've recently seen a dip in the Apple share prices, hitting a 3-month low after hitting a peak about 1 month ago. While investing in any stock short-term is more dangerous, I think that this could be a great time to buy the dip, as this has worked well for Apple investors in the past. In recent news, Apple has planned to increase its dividend, and while its dividend is small, this is always an added bonus. Analysts are forecasting Apple selling well over 200 million iPhones in 2021, and a lot of this is due to the fact that over 35% of the iPhone users out there are due for an upgrade soon. The recent iPhones haven't really excited me too much, so I have been putting off upgrading my own phone in quite some time. I think that this year people will be upgrading in record numbers, and another reason for this is because of the all-new 5G technology. We'll also be seeing the new M1X MacBook Pro coming out later this year in both a 14 and a 16-inch variant. The new M series chips have outperformed Intel's offerings while using much less power, and the tech world has been obsessed to see what Apple can do in terms of CPU tech over the next decade. The consensus is that Apple should be able to grow their earnings per share by up to 35% in 2021, bringing it to about $4.42 per share. However, analysts do think that the earnings per share growth could slow down in the future years. While right now the stock market is definitely feeling a little bit bearish, I do think that picking up Apple on any dips is extremely smart. Investors that have done this in the past have been rewarded handsomely. And although past performance doesn't necessarily equate to future performance, this is definitely something to keep in mind. And also, while Apple is not a high momentum growth stock that induces FOMO in people, it is a high quality stock with strong fundamentals that should perform strongly in the next decade. That's why I added more Apple stock during the recent dip, and I will continue to dollar cost average throughout the next few years. So yeah, that is my list of top stocks for the month of March 2021. If nothing resonated with you on this list, also check out GE, Square, Uber, Microsoft, AbbVie, Lululemon, and CrowdStrike. These are some companies I definitely will be following throughout this year. Before you guys invest in any stocks, you guys must do your own due diligence. I know this video is called the top stocks to buy for this month, but you guys, I honestly have no idea. This list is the result of my own research, and that definitely does not guarantee you that these stocks will perform well in the short term. However, I am quite certain that in the long term, these stocks should do quite well. So yeah, definitely don't view this list of stocks as recommendations or financial advice. I'm not a financial advisor, and this video is just for entertainment purposes only. And yeah, in the last half year, you guys, most stocks have gone up a lot. So that's why it's important to diversify your portfolio with safer companies that have strong balance sheets and are not just hype stocks. It's also important to buy index funds to reduce your investing risk. Some of the companies on this list are definitely riskier and some are safer. But please, you guys, do your own research and trade according to your own risk tolerance and your own judgment. Thank you guys so much for watching. Happy trading. And if you guys like the video, make sure to hit that like button and also subscribe to see more videos just like this. I make a ton of videos about investing, personal finance, and entrepreneurship. Thank you guys so much again, and I'll see you in the next video. Peace.